Welcome back to our intermediate financial accounting class. In our last segment, we started talking about how we account for leases. All right, we started out our discussion with why they're so important, but last time we started talking about the how. And now we need to continue that by looking at a specific example and doing the lessee accounting. Now, don't forget, we still have lessor accounting to talk about, how we classify leases for the lessor, and then the steps to lessor lease accounting. But we want to focus now on the lessee so we keep it all together. So in order to practice this, of course, we need to have a problem, and that brings us to Hanford Incorporated. So Hanford and Cisco Leasing signed a 4-year lease for a piece of manufacturing equipment. Cisco believes that the equipment has an estimated economic life of 6 years, a residual value of $60,000. The estimated market value of the equipment is $300,000. That's also its carrying value on Cisco's books. So Cisco is not a producer. They don't make the asset and then sell it like a car company might. If you lease from Toyota, they make it for $15,000, let's say, and lease it for 20 or 25. That's not what Cisco does. Cisco would buy the car or truck from Toyota or whatever car manufacturer you want to think about, and then they would lease it for whatever amount they paid for it. So there's a slight difference there in the way we do the accounting, whether you make it or you buy it and then just lease it. One last thing here before we move on, and I know we're supposed to be talking about lessees, but this is an important issue. Lessors have two ways to make money. They can make money simply on the interest that's implicit in the lease payments, or they can make money by using the lease to generate a sale. And when that happens, they get some sales revenue from actually selling the lease, and they make the interest as well. So that's the business model. Now the accounting is different, but those are the business models. Cisco's in that first category where they're just trying to make the interest from the lease payments. They're not trying to also sell this asset off. At the end of 4 years, Cisco thinks that this piece of equipment will still be worth $100,000. Hanford has not guaranteed that, which means that they aren't promising anything. If I haven't guaranteed it, then if it's only worth $50,000, that's Cisco's problem. I don't care, which is a nice way to do the lease if you're the lessee, a little more risky if you're the lessor. Cisco uses a 4% implicit interest rate to determine the payments on the lease. Hanford doesn't know that, so they use their own implicit interest rate, which is 5%. And typically you see this kind of a difference. A lessor uses whatever their normal rate is based on the risk of the lessee to decide what they're going to charge. The lessee, on the other hand, if they don't know what the lessor is charging, and often they won't because the lessor doesn't want them to know how much they're charging, but if the lessor doesn't tell them, then they go back to what it would cost them to get a loan to buy the asset. And typically that's higher than what a lessor would charge. That's one of the reasons why we get the lease instead of getting a loan and buying the asset. So typically we see the lessee's rate being higher than the lessor's. Based on this information, Cisco has set the lease payments at $56,825. They'll be payable at the beginning of each year. Now we'll stop here again. This is a really important concept. Up till now, when we've done time value, we have assumed all payments would be made at the end of the period. Because bonds and other forms of debt, that's when they pay, right? Interest accrues all period long. We make some kind of a payment at the end. But just like when you lease an apartment, they want that first month's money right up front. Most leases are what we call annuities due, meaning it's a string of payments, but they're made at the beginning of each period as opposed to the end. And please make a note of that, highlight it, circle it. It's a different table. If you're using the present value tables, it's a different button on your calculator if you're using a financial calculator. So please make sure you make a note of that so that you get the right style, the right method, the right calculation, or you're going to mess up a lot of these calculations. So that's one of our key concepts, is that leases are almost always annuities due as opposed to payment at the end. Last couple points here. Hanford spent $15,000 to initiate this lease. These are legal fees, their credit checks, their verification, maybe some accounting stuff they had to pull together. It's also the closing costs that were required by the lessor. It could also be some points that were assessed because of risk, whatever. But they paid $15,000. Cisco does this all the time, so it doesn't cost them nearly as much. So they only paid $4,000 in legal fees. At the end of the lease, Cisco is going to retain the equipment. So now that we know all these basic numbers, it's time to start putting together an amortization schedule. That's our first step. Now, fair warning on this. Once you know how to do an amortization schedule, and your family knows that you know, and that you're an accountant, you will be doing these for people for the rest of your life. Just be forewarned. we use these kind of schedules to show when debt will be repaid. That's what they're for. Because of that, if you're going to put an addition on your house, if you're going to refinance, if you're going to take out a mortgage, student loans, car loans, credit card stuff, all of the basic debts that people can get into, they can be summarized in a table like this. So now that you know how to do them, or are about to know how to do them, you'll be doing them for the rest of your life. So fair warning, I have let you know that this is coming. I actually keep a file that's a blank amortization schedule. I can just pop in the numbers people need and then just email it to them. So be forewarned. This is something that you want to be comfortable with, because as an accountant, you'll be doing it forever. So don't say I didn't warn you. Let's start out this process by putting in the information that we already know. So we know that the lease payments are $56,825. Usually we know that number as the lessee because the lessor just tells us this is how much you're going to pay. We also know that our closing costs were $15,000. We know too that the market value of this asset is $300,000. The residual value that the lessor wants is $100,000. But I'm not going to pay that. I don't have a bargain purchase option, and I didn't guarantee that it would be worth $100,000. So from my perspective, this is a zero, because I don't care what they think it's going to be worth. All I care about is what I'm going to pay, and I'm not paying anything. So I leave that as zero. If there was a BPO or a bargain purchase option, or if I had guaranteed that it would be worth $100,000 when I gave it back, or if I planned to buy it, then I would put that amount in here and use it for my calculations. Now, another of our key concepts. What is a bargain purchase option? A bargain purchase option is the right to buy the asset at a lower price than anybody else could. So Cisco thinks this asset will be worth $100,000 at the end of the lease. A bargain purchase option would be the right to buy it for, say, $90,000 or $50,000 or $20,000. Not the right to buy it at $100,000. That's dibs. That's not a bargain purchase option. The right to buy it first isn't the same thing. A bargain purchase option, emphasis on bargain, is the right to buy it more cheaply than that estimated future value. So be aware, that's a bargain purchase option, and that's an incentive to buy it at the end of the lease. So that would automatically kick it into the financing account. But in this case, there's no bargain, and we haven't guaranteed that it will be worth $100,000. So we just put that in as zero. Now, we don't know what interest rate Cisco used. I mean, we know because we're doing the problem and it told us 4%, but Hanford's accounting team doesn't know. So they use their incremental rate, which is 5%. And we know that we're going to make payments for 4 years. So that's our basic information. Now we're going to use that information to calculate the numbers over here in pink or red. So the first thing we need to do is get the present value of the BPO, or the residual value. That's this number. And the present value of 0 is 0. But if I were to do this calculation, it would be the present value of a lump sum. I can do the present value of the lease payments. This is the present value of the payments, and that will be equal to the payments times the present value of an annuity due in at a given percentage. So I know those numbers. I know that the payments are $56,825. Present value of an annuity due, N is 4, percentage is 5. I could either pop that information into my calculator, or you could go to a table. So let me go ahead and go to the table. We're looking for N of 4 and 5%, so 3.72325. And if I multiply that, I get $211,574. That's the present value of my lease payments. Now, my lease liability is the sum of the present value of the BPO and the residual value and the present value of the payment. So in this case, it's the same. And my right of use asset, this is what FASB calls a leased asset now, is the sum of the lease liability plus the initial direct costs. And it gives me $226,574. And now I've got all the numbers I need to do both my amortization schedule and my first journal entry. So let's finish out this amortization schedule. I'm going to start with the lease liability, so that's this number. I'm going to bring it down here, $211,574. And then I'm going to start putting in my payments. So payments are made at the very beginning of the lease. So I'm actually going to make a first payment on the day the lease is signed. So $56,825. What would my interest expense be for that first payment? Now, when I ask this in class, I typically see my students start to do a calculation. They take that $211,000 times 5%, and they tell me that that's interest expense. But that can't be interest expense because interest expense accrues over time. And if I am taking out the lease and making the payment on the very same day, no time has elapsed. If no time has elapsed, then how much interest expense is there? None. So this is actually a 0, which means that all $56,000 will go towards paying off the lease. So I end up with $154,749 as my lease balance going into this transaction. Now I'm going to make another payment a year later, $56,825, and now a year has passed from January 1, year 1 to January 1, year 2. So I'm going to take the $154,749 times the 5%, and that's going to give me $7,737 as my interest, which means of the $56,825, only $49,088 will go to paying off the liability, which leaves me with $105,661. And I can keep going. So let's see, $56,825. I make another payment. Now I take the 105 times the 5%. That gives me $5,283. So of that, $51,542 will go to the payment. So that gives me $54,119. I'd make another payment of $56,825. This time my interest will be $27,006. So $54,119 leaves a balance of 0. Now, 2 quick things to finish off our amortization schedule. First off, this is a key concept. You have to know how to calculate an amortization schedule. So this is really important. Number 2, at the end of this amortization schedule, you may notice right up here that this number may come out differently than the number that you actually calculated. Sometimes that happens. I rounded everything to the nearest dollar. If you round to the nearest penny, you usually don't have rounding issues, but sometimes you're going to finish off this table and you'll end up with $1 or $2 over in this lease liability balance. It's because of rounding. And when that happens, you need to adjust interest expense in the last period. That's the rule to take care of any rounding issues. So just be aware, if your numbers don't match mine exactly, it's a rounding difference. Fix that last number and you should be good to go. Last thing, from an accounting perspective, we have everything we need here. But a lot of people want the last few numbers, and that's these down at the bottom where you add up. We're actually paying $227,300 on this lease. That's the total amount of cash. $15,726. That's the interest that we ended up paying. And of course, this should add up to the $211,574 so that these two numbers match. So those 3 numbers not required, but you might as well get in the habit. A lot of business leaders will want to know, well, how much cash are we actually going to have to pay? How much interest is it actually going to charge us on our books? Now, we've done a lot of stuff getting this calculation done. There's more fun stuff coming. Those are the journal entries. I know, bummer that we didn't actually get the entries done, but we've gone a little longer than I wanted to. So we're going to stop here. When we come back, first thing, I promise, journal entries coming up. We'll see you then.